Interest rates in euro area are finally dropping. How can you profit from it? Easiest way, if you need money, if you're taking up a loan, of course it will come cheaper with low interest rate levels. So you profit if you are in debt. That's the easy part. But what if you have money to invest, which interests us more in this case? Then the answer is not so unambiguous. Let's have a closer look. Here in the chart you see what we do expect for interest rates. You have the interest rate level of the European Central Bank. So the basic interest that drives all the interest rates in euro area, recently until last week at a very high level of 4%, and now it has come down by a quarter to 3.75%. Not helping much yet, but we and everybody else expects further rate cuts this year and probably also heading into next year. How far down? You see in the chart an average interest rate in the euro area in the long term was about 2 to 2.5% in an ordinary year. And we think in the medium term, that's a level where we can come back to. Maybe not all in once, but that's a level to expect. The bad news, if you put your money on a savings account, then also the interest rates you're getting there from your bank will come down now over the next 12 months with every rate cut from the central bank. So you will earn less interest on the money to invest. That's the bad news. The good news is there are ways to guarantee you this current interest rate level for a longer time. And on the capital markets, the classic instrument is simply a bond. So you invest money in a bond, you are promised this money will be paid back to you after some years, and you earn an interest rate. And usually this is a fixed interest rate. So even if market rates are coming down, you will earn this fixed interest rate for the time of these bonds for several years. That's the easiest way to do. How much can we earn with such bonds? What's the interest rate level to expect? As always, depending on the risk you're willing to take. For the safest bond class, which is in the euro area German government bond, you can currently expect around 2.5%. That is being paid out over the life of this bond. In this case, it's a 10-year maturity German government bond, so it will be paid back only after 10 years. If you say, well, 2.5, that's not much, I agree. If you're willing to take more risk, Austrian government bonds, still very safe, will pay a little more, approaching 3%. If you're willing to take more risk, you can invest into corporate bonds, so bonds where companies owe you this money. Here is really very important to diversify, because one company can go bankrupt, you will not be paid your money, so you have to invest in dozens of company bonds at the same time. An easy way to do this, of course, is simply a fund investing in such corporate bonds where you have this diversification effect. How much you're earning there for good quality corporate bonds? 3.5% roughly, and higher if you take more risk. If you say now, well, 3.5%, this is still not making rich, I would agree again. But for everything else, you have to take more risk. And here, in the end, we also have to shortly talk about equity markets. How are equity markets performing when interest rates are coming down? We have it here in the chart. And of course, as always, that's only historical data. No guarantee that the future will behave the same way. But that's the data we have. And it does make some sense what you see here, which is, look at these shaded areas, the red areas, that's the recession phases. When did you see the strong interest rate declines in recessions? Then interest rates are coming down a lot very fast. At the same time in recession, company earnings are falling, which is bad for the equity markets. So also equity markets are falling. What you see here is the phases with the strong rate cuts in recessions have actually been bad equity market years. But be careful, that's not what we expect for this year and next, because there's no indication that we are heading towards recession. We're just coming from one. We had a recession in the euro area late last year, and now all the indicators are showing that the economy is starting to grow again, heading to average normal growth next year. So this would be more comparable to the years 2012 to 2016 in this chart. What happened then? We got some interest rate cuts. Not too many, as this time. We don't expect rates to come down to 0% again. Some rate cuts, but the economy continued to grow. And at least during this period, this was one of the best phases for equity markets, because companies are still growing their earnings because the economy is growing, what we expect for this and next year. But interest rates were coming down a little bit, which helps in addition. So surprisingly enough, we see a decent chance that this and next year equity markets, performance-wise, will be actually one of the main beneficiaries from ECB central bank cutting rates in the euro area. Let's have a look. We will keep you updated, of course, in the next follow-ups. So make sure you subscribe to the channel, hit the bell. We wish you all the best with investing, and see you next time.